welcome everybody. My name is Nash Middleman. I'm a buyer's agent on the Joe Dickerson Group. Joe is my partner there.
I'm Joe Dickerson with the Joe Dickerson Group, and we're excited to be hosting this house hacking class. It's something that we have a real passion for, so we're excited to share our passion, our knowledge, our insights, and see how we can help.
Yeah. We love interaction with these classes. So if you have any questions, don't be shy. Type them in the chat box, and we'll make sure we get to them. And I guess we could just start out by asking everybody, what drew you to the class, and what are you hoping to get out of it? And feel free to just start littering the chat box with questions. We're ready whenever you are. We'll just get started in a couple minutes here. Wait for the rest of the people to filter in.
Let's get started. So we're here today to talk about house hacking and how to build wealth through real estate, all without needing a ton of money or knowing how to fix toilets, and at the same time providing yourself with a place to live, and ideally while lowering your monthly out-of-pocket housing expenses. This is a strategy that my wife and I have been doing for 12 years now, I think. And I'll tell you my story and how I got to where I am now and why it was such a key part of my wealth building adventure. But for you guys, are you guys ready to put your money to work for you through investing in real estate, as well as overcome your fears for getting started? And use potentially house hacking or other strategies that we might talk about to build true wealth and create a legacy for your family. We love to see you say, yes, we are. Type that in the chat box. Let's get some engagement going and some energy so we can really push through what's holding you back from starting this wealth building adventure. I'm gonna let 2 more people in real quick. Alrighty, so, thank you, Nash. If you wanted to invest in real estate but didn't know where to start, or else maybe you've gotten your funds ready, but then got scared of the risks or the process, or have you been curious about whether this strategy, this house hacking idea, is even the right fit for you and your goals? If you're on this list, you're in the right spot. We're going to work through these things and figure out. Number one is this strategy the right fit for you? And then obviously how to actually move forward and get rolling. And so this class is all about these things here. Building wealth through real estate without any real estate investing experience. So this is for beginners. It's also for, people like Jean, who I know has a lot of experience investing in real estate. We're going to talk about how you can do it all without needing a ton of money or fixing toilets. Not to say that money doesn't help, and fixing toilets is also something to save money, yet it can be done without those things. And so everyone here is probably somewhere on the spectrum, I hope. Either you've never invested in real estate before, or you have, but you're here to learn more. And that's great. We welcome all of you and are so excited to have you here and ready to get rocking and rolling.
So today's goals for the class. Number 1, discover whether house hacking is the right fit for your wealth building and homeownership goals. And number 2, gain an understanding of how house hacking works in real world scenarios. We at the Joe Dickerson Group offer a ton of different services. And as Joe mentioned, we have a real passion for helping people build wealth through real estate. House hacking is an extremely powerful strategy just to do that. And while it's extremely powerful, it is a more active way of investing in real estate, and it might not fit for everyone's real estate goals. So hopefully we help you gain some clarity around that.
And so we're going through 3 things. The very first, I'm going to tell you my story. Again, my journey in wealth building through real estate and how it all got started with house hacking, and how house hacking continues to be an important part of my wife and I's strategy towards building wealth. We're going to go through 5 of the most common myths that we see in our clients that are keeping people from holding back in executing on this strategy. And we're going to tackle those myths. And then we're going to go through the 3 keys that we find are, well, key to your success. So here I am when I was much younger and had more hair. Well, actually I have a lot of hair now since I can't get a haircut. Back in, I guess this was a dozen years ago, my wife and I started our house hacking and real estate investment journey with this row house. This is in Washington, D.C. And, you know, we started our search like a lot of our clients do, in not knowing anything about this house hacking idea. And we were just looking for a more permanent home, and we didn't want to rent anymore. We wanted to own our own place and invest in a home and start building wealth through real estate. So we started looking at a lot of condos, which are in our price points, and got turned off very quickly by the high HOAs and the lack of control over our living space, essentially. So our real estate agent at the time, before I was in real estate sales, suggested that we look at these row homes, which are 2-unit dwellings. This particular one has a 3-bed, 1.5-bath apartment upstairs and a 1-bed, 1-bath apartment downstairs. And, you know, in doing the math, we very quickly realized that we could live in this 3-bed, 1.5-bath apartment and own it for less than we were paying in rents in our previous place. How the math worked out in this particular example, our mortgage payment, including taxes and insurance, was about $3,200 a month, and we were getting $1,600 a month. I think that was about right. So ultimately, we were paying $1,600 out of pocket to live in a 3-bedroom house that we owned, and we're building wealth at the same time. And you can see the pictures on the left there. We put some sweat equity into it to make it our own and build wealth through sweat equity as well. And fast forward, you know, buying that very first place, which is the one on the far left, allowed us to move on to our second place, which is the one just to its right. And by buying that place, that allowed us to move on to our third and fourth, and ultimately our house that we're living in today, which is the one in the top right corner. And then that allowed us, through house hacking and producing passive income and building equity, allowed us to go on to invest in real estate all over the country. So we have active investments in Huntsville, Alabama, which are looks like the bottom right 2 pictures are 2 of our buildings there, as well as invest passively through syndications, which we can talk about a little bit later, in all the other apartment complexes that you see there. And this was all, it really is all because we started out house hacking instead of buying the condo that we were originally looking at. So I attribute you know, a lot of our wealth and where we are today to executing on this strategy. And the great thing is that, and we'll get into this, is by doing this, it saves you money in the short term and builds wealth faster in the long term. So it really is a win-win as long as you're willing to put in the work when it comes to being a landlord. And we'll talk about some of the challenges there in a bit.
So Andrea asked the question, she's curious about how long one should live in the house before moving out and renting out the next one. I don't know if you or Robert shed some light on that.
Yeah, I'm sure we both have some insight. Well, I can tell you in our second home that we bought in 2000, we closed on Valentine's Day 2010, and we moved out of the country on, when was that? June 1st of that same year. So we were in that house for barely 3.5 months. Is that normal or accepted by lenders and everyone else? You know, it's debatable. It's all about intention, and Robert can speak to this. But what we know to be true is when you intend to live in a house, it doesn't really matter how long you live there before moving out and doing the next one. And there are some exceptions there. Like if you're with an FHA program, you'll have a tough time buying a house with FHA and then very quickly buying a house and get approved for that financing. So I'll let Robert speak to that. If he's on, he can unmute and chat a little bit and answer that.
Yeah, I just ran into this recently because I had a client who wanted to move out and they wanted to move out really quickly. You now sign a document when you close on a primary residence loan that's an affidavit that says that you agree to live there for 12 months. So really you can't move for 12 months. Now, if you do and you have a good reason, then what are they going to do, right? But if you do move and they find out, they may question you. And if they don't determine that your reason is good enough, they can make your loan due and payable all at once. And if you can't pay it, they can foreclose on you. So basically, it would force you into refinancing it as a different occupancy. That's unlikely to happen. So what I recommend people do is just make at least 6 mortgage payments before you consider moving. I don't advise moving out very quickly. You know, in Joe's case, he had a great reason. You know, and he can share that. You know, if you say, hey, you know, we found out we're having a kid, or we got a job change, I had to move. You know, reasons that are outside of your control, and you'd have to kind of prove that depending on what it is. So you just want to be careful with it, but you don't want to plan to do it within less than 6 months. You can avoid it.
Thank you, Matt.
Yeah. Yeah. If there's any follow-up questions, throw them in the chat, and we'll be sure to get to them. So I like to start off with this slide. It's almost an aside to what we're talking about, yet I think it helps with the bigger wealth building through real estate picture. Is when you're investing in real estate, you've got a spectrum of types of investments that you can make on the scale of active to passive. Active being ones that you are actively involved in, managing and fixing and potentially living in, all the way on. And then on the other end of the spectrum, you have passive investments, which are those that you might invest in with money, write a check, and then you don't have to think about it and you get mailbox money. And then there's strategies in between. So I like to start off by showing you some of these just to help open your minds about this spectrum, and that's maybe house hacking is a little too active for your tastes and you want to do something more passive. That's great too. We can absolutely connect you with the right investment. So house hacking, you're living in the property, it's pretty active. You are living with your tenants. It's potentially a lot of work, and we'll talk about some of the challenges and the joys of living with tenants a little bit later on. Out-of-state investing is also on the active end of the spectrum, but maybe you have property management, so it's a little bit less active. And then you have things like realty shares, or there's a whole bunch of those types of companies where you go and pick your investments, invest your money, and hopefully get paid dividends. That's more on the passive side. And then you have REITs, which are similar-ish. You might have a local rental, again, active. Where am I? Oh, flips. Flips are very active. Did one in the fall. It was very stressful and took a lot of work. And yet, you know, you get rewarded for the work that you put in. And then syndications, they're on the far end of the passive side. Those are group investments where you write a check and you get mailbox money and you don't hear about when a toilet clogs or when a tenant moves out. That's just all taken care of by property managers and asset managers. So big spectrum. Today, obviously, we're talking about house hacking, which is going to be on the active side. And I'll let Nash take over and talk about some myths.
So now we're going to disprove some of the 5 myths that may be holding you back from getting started in real estate. Jon Snow, there will be a replay on this, or we'll email it to you. Just
yes.
Yeah. So without further ado, myth number 1: you need hundreds of thousands of dollars to get started. This may be true if you're looking for a $1 million property in Pack Heights, where it's an extremely competitive market. You're going to need a couple $100,000 as a down payment, and on top of that, some closing costs. Yet to get your foot in the door, and to start off by making your initial investment, the FHA, the Federal Housing Administration, offers loans right now that are available and require as little as 3.5% down. And on an $800,000 property, where that's a sweet spot for inventory in the East Bay and the Inner East Bay, on an $800,000 property, that's about $28,000 plus closing costs. And once you can acquire the asset and start building some real equity, there are strategies that you could use to make your second investment once you built some equity. And it's a real powerful strategy to help build wealth, again, through real estate. Also, right now in the multifamily segment of the market, we're seeing a much less competitive market than we've seen in the last 4 years. And there's properties that are sitting out there longer than normal, where in the past they may have received multiple offers. But given the market is less competitive right now, it's leaving the door open for buyers to get in a contract with a lot less than 20% down. Yeah. Myth number 2, you don't have enough time to invest in real estate or purchase your first house hack.
Okay, nice.
This is a great place to answer a question that came up earlier about the VA for multi-unit properties. So let me go back to myth number 1, because VA loans they can be $0 down in order to close on them if you have VA benefits. So Robert, if you're around and want to talk about how VA could work on multifamily homes, that would be swell.
Sure, I'd be happy to chat about that. So it depends on a couple of factors, but VA will finance 2 to 4 unit homes. You can do 100% financing. You typically need money for closing costs, which when you're buying in cities in Alameda County, there's additional costs involved, such as transfer tax. I'm sure you guys are going to get to that. And then there's some complexities to it. If you need rental income to qualify, there's a couple of different guidelines and steps we have to check into compared to other loans, but it's definitely doable. And if you're a veteran, first of all, thank you for serving our country. And secondly, we can definitely help you finance a 2 to 4 unit home using a VA loan.
Cool. Thank you.
Mm-hmm.
Sorry to cut you off.
Nash, please continue.
Myth number 2, you don't have enough time to invest or purchase your house hack. This can also be true, and this could be one of the reasons that may be holding you back from making that initial investment. There are so many options out there that are available to you, and real estate is an extremely complex transaction. You have real estate agents to choose from, loan products to choose from, property types, neighborhoods, and it's a lot to consider, and it can be extremely overwhelming to weigh all the factors that go into making sure that you're making the best decision for you and your family. Yet this is where building and leveraging a team who are going to take the time to understand what your goals are and can help you recognize an opportunity that would be a good fit for those goals is super important. Joe and I have built careers around helping others build wealth through real estate. Robert's one of our preferred lenders, and he can help tailor a loan product that's going to work best for you and give you a lot of clarity around something that would be feasible for you to make your initial investment and start building some real wealth through real estate. We're in the trenches every day living and breathing this stuff, and we can help you filter out a lot of the noise to make sure that not only are you successful, but you're successful in a time frame that works for you with the least amount of obstacles.
So
Essentially, Nash, it sounds like you're saying we are leverage for people. People can use their real estate agents as leverage to save them time.
Exactly. And if you haven't been to our website yet, there's also a ton of great resources on there. Joe blogs like every other day about new happenings in the real estate market. So definitely visit our website and poke around on there for some great resources as well. The Bay Area is an extremely, can be an extremely competitive market, and it's kind of an anomaly in the sense that there's not a lot of inventory. So some of the resources that you might find online aren't specific to our area. Yet if you're looking to invest out of state or other markets, we can also point you in the right direction for other resources that can help you be successful. Right, myth number 3. You need to be handy and know how to fix toilets. Being handy certainly helps when owning multifamily properties, and Joe can definitely attest to that. It is a more active way of owning real estate because you do have to fix things. Toilets is an extreme example, but not sugarcoating anything. There's things, there are drawbacks, whether it could be tenants, it could be maintenance. And it's not all sunshine and rainbows. We didn't talk about Ben and Abby yet, right?
Correct.
Not yet.
But yeah, right. Yeah, we'll get to a great case study of some of our favorite clients. Yeah, I mean, in terms of the fixing toilets, it's an asset. It helps, and yet you don't need to be handy or know how to fix toilets. There's nowadays with TaskRabbit and everything else, there's so many ways to get maintenance done cheaply and quickly. So again, it saves money if you do it yourself, yet it's not a requirement.
On the other hand, one of my favorite benefits of owning real estate is pride of ownership, where you can take a property and make it yours, and sweat equity, and working on a property that is yours is a great way to make improvements and increase the value of the property while living in it, which can help with the quality of life.
Absolutely.
Favorite myth right now.
Myth number 4, now is not the right time given the market. We feel this question a lot, and if anyone is out there who is concerned about now not being the right time given the market, I would love to hear some feedback in the chat box. There are some extreme external factors that are impacting the real estate market, and this is a valid fear. We have a recession looming. What if you buy a property and the value drops, or maybe you're waiting for the market to crash and you want to buy low so you can get some instant appreciation. It's really hard. I don't think anybody can actually predict what's going to happen in the future or how the ripple effect is going to impact the real estate market. And the reason for that is we've never been in a position like this before. At the end of last year, I don't think anybody thought that we were going to be in a pandemic in the second quarter. Yet again, here we are. So there are some parallels that we can pull from in the past, but not great ones. And what we do know is right now we're seeing a much less competitive market than we've seen really in the last 4 years. And interest rates are historically low, which actually makes it a great time to lock in a low interest rate on a multifamily property like a duplex or a triplex. And Joe, I think you can speak a little bit more on this, but I know inflation is one of the external factors that people aren't really considering when looking to buy real estate market, or it's kind of a sleeper when it comes to how it could impact the real estate market.
Right.
Yeah, I mean, the short of inflation, over the last dozen years or so, the average rates of inflation have been between 1% and 3%, and now the government has been pumping so much money into the economy, and for good reason. And it's probably a necessary thing that they've done, and yet that is one of the major causes of inflation. And we also have the other two causes in the Bay Area, the demand, supply push and demand pull, that are causing inflation locally as well. So the great thing about locking in a mortgage right now is you're potentially locking in at or below the rates of future inflation, which is a great thing. That essentially, I say this a lot, and maybe I'm not the economist that should be speaking like this, but it's essentially free money when you are borrowing money for less than the rate of inflation. And Robert might have some tidbits to add there as well, so speak up if you do, Robert. Otherwise, we can move on.
Yes, I definitely do. Well, first of all, like you said about the market, I tend to think the same as you do on that. With the housing starts in the Bay Area have been really far behind for the last decade or so. So basically what that means is based on the population, we can get data on how many people each year get added into the mix of what we would call first-time home buyers. And then we look at housing starts, how many new homes are being built, and how much inventory is coming on the market. And so there's a big disparity there. There's a big gap in how many buyers are being added to the market every year, and how many new homes are being added to the market every year. So the demand is really high and the supply is really low, which is going to drive prices up. the other thing that we look at is low rates. Low cost of financing drives real estate market as well. So you're not going to see a crash like you did in the mortgage market back in 2008. That was really specific to mortgage related. In fact, if you look back at the last like 5 or 6 recessions, most of them didn't negatively impact real estate. You actually saw real estate growth during those recessions. So I wouldn't be too concerned about buying and then real estate values going down. The other thing I always want to point out there is that the value of your home is really meaningless except for when you go to sell it, or if you're doing a cash out refinance, right? So if you are planning to buy a house like a multi-unit property, it's probably a buy and hold strategy. Like Joe, you bought those properties in DC. How long have you had them for now?
12 years.
12 years. So does it matter what the value's been in between when you bought them and now? No, it doesn't matter at all. Go down to 0, go up to 10 million. It really matters when you sell it. So I would look at it from a perspective of what's affordable, for what you can afford every month as a monthly payment, especially if you're going to live in the property. And 2, is it a good investment? And Joe and Nash are really good at helping break down those numbers to make that determination.
Thank you, Robert. Very clear and concise.
Yeah.
So let me go back to the recession thing. I thought I had slides in here. I apologize, I don't. Happy to send them on after this. I can send them to everyone. But Robert mentioned that in past recessions, real estate prices haven't drastically been negatively impacted. And I thought I had a slide on just that fact. Except for the 2008 recession, the prior 4 recessions saw basically no movement in real estate values. I think one of them was essentially even for a 3-year recession. The rest, real estate actually appreciated during that period. So it is a fairly recession-proof asset, typically speaking.
Yeah, and in response to Chris's comment about the Bay Area housing market being expensive, I completely agree with you 100%. Yet it's important and good to know that if you stay ready with a mortgage and you leverage a team to actively look for opportunities for you, there are great opportunities even in an up market. You don't have to wait for a recession for opportunities to materialize. There are always opportunities out there. And I don't see the Bay Area housing market prices dropping necessarily because there is so much demand and not enough supply for everybody who's looking to purchase a home. We are seeing, I think May was, what was it, like 17% of inventory from May 2019, and now we're seeing a kind of flood of inventory coming on. We're back up to close to 50%.
Yeah.
You're talking about how inventory compares this year versus last year, given our shelter in place and ongoing pandemic. The first 2 weeks of shelter in place, we saw 50% less new inventory come on the market compared to the year prior. And you see that number slowly go back up to close-ish to normal. So the last 2-week period that was assessed was about 17% less than last year. So we're getting back up there. John Snow has a great question. It disappeared on me, but I think I read it. What happens if corporate offices get turned into residential? Is that what it says?
Yeah.
Okay. And this is, I would love that because we have such a housing shortage and we need housing. The challenge is the way that our cities have grown up makes it very challenging to change use, to develop at all. So we're years and years and years behind on new housing developments that should have been happening. So even, first of all, converting something from commercial to residential probably has to jump through similar hoops to building from scratch. So it takes time and a lot of money. And also, it would take a lot to make a dent in our housing shortage, in our supply side issue. I know that our local politicians, especially our local city councils, I should say, are very focused on the demand side. They're focused on rent control and what can we do to make housing more affordable, but they don't do anything to address the supply side issue. They don't make it easier to build new housing. finally the state stepped in and said, all right, you can build ADUs, pretty much in-law units or accessory dwellings, pretty much on any property, and cities can't stop you. So we're starting to see some regulations change towards allowing more inventory, and yet I think we're a long way behind. Chris, we'll come back to that question towards the end, and make sure all your questions are addressed. That last one about gated communities. Did we talk about investing in real estate being risky, Nash?
Yeah, not yet.
Go for it.
Short answer, yes, it is a good investment. We'll elaborate a little bit more on that. Myth number 5, investing in real estate is risky. And sometimes it is risky. There are downfalls and pitfalls that you need to be aware of and conscious of. Yet the safest investments are always the ones that you best understand. And by doing your due diligence and going into an investment with your eyes open can really minimize that risk. And this is where, again, helping, like our team can help you do your due diligence and understand what the condition of the house is and what the full cost and monthly payment is going to be, not just with mortgage, principal and interest, but also looking at taxes, tax benefits, insurance. And so you can get a whole what's the word I'm looking for?
Your monthly payments. Yeah.
Thank you. Yeah. And then even taking it a step further and understanding like some of, if there's going to be any new developments in the neighborhood, identifying neighborhoods that are going to see a jump in appreciation due to some new construction or developments, or the latter, which is maybe see a depreciation in the investment. Also, understanding some of the point of sale ordinances that are specific to Alameda County or the county that you're looking in. Those can really help minimize or maximize what your bottom line is, and can help you also avoid buying a money pit that's going to need a ton of repairs.
And we'll talk a little bit more about a few other risks as we go through some of the keys for success. So those were the 5 most common myths that we see. And if you have others, please throw them in the chat box and we'll be sure to address them. And as you saw, like we're not saying these thoughts are unjustified. Every single one of them has a root in truth, and yet they are overcomable. So hopefully you've gotten a glimpse of that. And now we're going on to the 3 keys that will really unlock your potential and maximize your investing success.
Right.
So,
go ahead.
Yeah, the first is knowing your numbers. So this kind of goes back to what Nash was just talking about with it being risky. And one of the biggest ways you can eliminate a lot of the risk is really understanding that the holistic costs and income of owning property. So we've got tools to help you with this. One is, I guess, to expand on what Nash was talking about, knowing the income potential. So we have tools like Rentometer, and you can also use tools like Zillow and Craigslist to get a sense of what market rents are going to be. And we also have a spreadsheet that's, I'm giving you a teaser, stay to the end, and we'll send you a spreadsheet that I've been using for a dozen years now, well, working on it for a dozen years, to really help analyze what an investment looks like in a house hacking situation or in a true rent it all out situation, to really help understand the numbers. And there's a little glimpse of that spreadsheet that I was just talking about. So again, we can walk through that one-on-one in more detail. But essentially, since this is kind of your primer to it, you'll have this. You're going to be editing the green fields, plugging in the numbers that work for you, and obviously there's going to be some that you may need help with. Again, reach out to us. Let us help you. One of the biggest examples that you can see right on the screen there is like, how do you budget for repairs and contingencies? So let's take a second to talk about that, since that's a big part of knowing your numbers. The truth is, well, you're budgeting, you're guessing. We don't know exactly what maintenance is going to cost and what repairs are going to cost, yet we can plan and be smart about our planning. We've done investigations. We know that the water heater maybe has 3 years of life left in it. So we know that we're going to need to spend $800 on a new water heater in the next 3 years. So we can take that cost and spread it out over the course of however many months. Same is true with everything else. And then, of course, you need a little extra money for when weird stuff happens, like tenant flooding one of your apartments. That's happened. Or rain flooding 2 of your apartments in the same weekend. That's happened too. So these things happen, and it's good to budget for them the best you can. Nash, do you have anything to add on that?
No, but this is our gift to you. And if anyone has any questions about this, Joe and I are happy to connect one-on-one and do a little bit more personal needs analysis and help you go through it so you can get a really clear idea of how to be successful with your goals. Yeah. Key number 2, understanding risk and recognizing the opportunity. We take the time to understand what your goals are and what's important to you, and it's our mission to make sure that you're successful. And we can utilize our huge network of vendors and professionals to make sure that you receive the best service and are successful with the least amount of hassle. Also, in regards to understanding risk and opportunity, back to Chris's question, is buying a house in a new gated housing development a good investment? I mean, it really depends on what's important to you. If safety and quality of life is important to you and you don't want to deal with managing tenants, then I would say it's a great way to start building equity and take advantage of a lot of the rewards in real estate, especially if you can buy one at a discount. If it's a brand new gated development, you might not see appreciation right off the bat, but I still think it's a better investment than not buying a house. That's my 2 cents anyway.
Yeah, that's true. And yeah, a big part of that, I think, too, is it's dependent on where. Is it a growing area or is it not? And if it's for a rental, if you're going to rent it out, can the rent income cover your expenses? Some people are happy to operate a loss on their real estate, and for some people, some high earners especially, that's important to help offset their high income and pay less in tax overall. The way I invest is I want my properties to cash flow. I love cash. I want to be receiving it every single month, even after all my expenses are paid. So that would be a big part of what I would look into. Is the rent going to be greater than my operating expenses enough to make it worth it? But we talked a lot about a lot of the risks. We haven't touched on rewards yet, but let's make sure we covered all our risks. The first and most obvious in Oakland and Berkeley and San Francisco, it's going to be rent control when it comes to house hacking. This is a limitation on landlords' abilities to set rents to whatever the market rent is on a particular property. So this can have a huge impact on running those numbers. You want to make sure that you're factoring in, for example, if you're buying a property with a tenant who is paying below market rate rents, you're probably not going to have an ability to raise those rents under rent control ordinances. So you need to make sure that the numbers still make sense with the decreased rent. But one of the bigger risks with rent control and other tenant protective measures is the unknown future, is what happens if, for example, the Oakland and Berkeley are working on a Tenant Opportunity to Purchase Act, which on paper, or I guess at a high level, sounds prior to them being sold to someone else. But the fact is that removes a huge amount of, a huge piece of an owner's rights to sell a property on the open market and hinders that sale and therefore impacts the value of the property. So that ordinance hasn't been passed here, It is in place in Washington, D.C.
So great, yet in reality it involves really long waiting times, first right of refusal, buyers that aren't interested in buying it until the first right of refusal is waived. So anyway, that's a big part of rent control. Just cause. Uh-oh, audio problem. Anyone else having an audio problem? Oh,
I think it's your computer. I think we all had it actually.
oh, how am I now?
What was the last part in regards to rent control? DC has what ordinance in place now?
The tenant opportunity to purchase.
Yeah.
Did you get that?
No.
Okay. Yeah. So I was yes talking about the Tenant Opportunity to Purchase Act, which allows tenants to for essentially a first right of refusal on a property.
Mm-hmm.
And it's in place in DC, for example, and it makes selling a property very challenging and impacts the value of your property. This is an ordinance that's being discussed here locally in Berkeley and Oakland, and potentially other jurisdictions shortly to follow, which will have an impact if you choose to purchase a house hack. It will have an impact on the property's value when you go to sell it. So it's a risk. Other risks, hopefully audio came through okay there. Other risks are vacancy, meaning it's empty, can't find a renter for it, as well as maintenance and problems. I alluded to a tenant flooding is actually 3 of my apartments, and it was malicious. Anyway, it's a problem that happens on occasion and can cost a lot of money and cause a lot of stress, and take your property out of commission for a number of months, thereby reducing your income. Recession, obviously on a lot of people's minds right now as something that can impact their investments. Though as we discussed earlier, real estate is often very recession proof. And also with a great multifamily investment, it doesn't matter if the property value decreases because it's still paying you every month. People always need a place to live, so typically rent prices aren't drastically impacted in recessions because, again, everyone needs a place to live. Tenant protections, we talked pretty in length about that. So let's go on to the fun side. Nash, tell us about some fun things.
Cash flow. That's one of Joe's favorites. So the reason and the way that house hacking can be a extremely powerful strategy is, as Joe mentioned, you need a place to live. If you can really know your numbers and minimize your monthly payment, and own an investment rather than rent an investment, when you do decide to move out, you could rent out the portion of the unit that you were living in, and it, in an ideal world, produces cash flow. And then you have say $1 million asset that is not only appreciating every month or every year, but you're also getting paid every month after all your expenses are paid.
And just to quickly define cash flow, it's essentially the money that you bring in, you subtract all your expenses, what's left is money that stays in your pocket, which is cash flow. What else we got? Equity.
Equity is, by definition, the value of your house after, let me make sure I'm saying this right. The value of your house after your loan is paid, right? More or less.
Sure. Let's rephrase that. Yeah. So equity is the value of your house minus the amount left on your mortgage. So it's essentially the amount of worth that you have in a given property. So value of the house minus the loan amount, current loan amount equals equity.
And the value is always changing. So with your principal reduction, the amount of the loan that you're paying off every month, it basically teams up with the increase in the appreciation of your house, and that's where it becomes a much stronger way to build equity rather than just putting money in a savings account. If you inherited a property, can you still use FHA as a first-time owner? Short answer.
FHA, yeah, short answer is FHA is not a first-time home buyer program. So I, for example, bought my second house with an FHA loan. So there's no requirement that it has to be your first home. There may be some requirements about how recently you purchased or inherited potentially, and Robert can speak to that.
Sure, yeah. There's typically some limitations when it comes to FHA. If you're using it as a first-time homebuyer, there's not really much limitations, but if you're using it for a subsequent purchase, they typically want to see that it's more than 100 miles away from maybe the house that you're departing, unless you're selling that house. That could be a different rule. So I would say first time, it's really easy. Second time, there's just a couple of hoops to jump through, but you can definitely use it a second time, such as Joe did.
Yeah, and times were different when I did it because it was on the same block as the first.
Oh, was it really?
Yeah.
Wow, right on.
Yep.
Yeah, typically FHA doesn't allow you to use departing residence rental income.
Right.
So that's something to explain that if you're moving out of a house and you're not going to sell it and you're going to buy another one, you would rent out the house that you're currently living in, right? And we would use that income to offset your mortgage payment. Otherwise, we'd have to qualify you for 2 mortgage payments. FHA has kind of made it so you can't do that. So you either have to qualify on your own for 2 mortgage payments or sell the house or refinance out of FHA first in order to do something like that.
Yep. Thank you, Robert.
Sure.
When it comes to tax benefits, this is one of my favorites also, so I'll chat about it for a second. There's a lot available to owners of real estate. The federal government is very generous and wants people to invest in real estate, and therefore gives us homeowners as well as investors a lot of tax benefits and tax breaks. On the primary residence side, it's a little bit more limited. You are able to write off certain expenses such as interest on your mortgage up to a certain amount, as well as property taxes that you pay up to a certain amount. But when it comes to an investment property, which includes the portion, which includes house hacks. So if you are, for example, living in a duplex, the portion that you are renting out is a investment property. And for that investment property, you can write off all sorts of things, unlimited mortgage interest, and private mortgage insurance as well, all the repairs that you make on that investment unit, utilities that you make, unlimited property taxes, of course, apportioned to that unit, as well as the ability to depreciate the entire structure. Well, the structure that is belonging to the rental unit. And what depreciation is essentially the ability to take an asset, which in this case is the structure, and write off the entire value of that asset over a set amount of time. So typically for real estate, it's 27 and a half years, but that can add up to tremendous amounts of money. I'm pretty sure my depreciation a year it's in the many tens of thousands of dollars that is offsetting my rental income.
Cool.
John Snow, if you have a roommate, I think I read the whole question before it went away. If you have a roommate, how does that work when it comes to these tax benefits? You're going to have to talk to your CPA. That gets tricky when we're talking about within the same house. And I cannot answer that for you with any sense of me feeling confident in the answer. So that's a CPA question.
That's not one way or the other. I've heard a bunch of different opinions, but definitely talk to your CPA to get a more.
Yes, I've heard opinions in both directions as well. Some say, yep, treat it like an investment, write off that room, whatever it is. And others are like, you got to declare the income, but you don't get any of the benefits for the rest of it, for it being a true investment.
If it was me, I would just take the monthly check and put it towards the mortgage and call it a day. That's just me.
Or have them pay in cash and pretend it never happened. I didn't say that. All right, Nash, tell us about appreciation. Okay. No Nash. All right, Nash is gone. So I'm taking it from here. Okay. All right. So appreciation is another great reward of real estate. So essentially that's the increase in value over time. We know that real estate is an appreciating asset over the long run. On average, nationwide even, we're like at 4 to 6% annually for forever, even when you factor in great recessions and depressions. Here in the Bay Area, it tends to err on the higher side because we have geographical constraints, and that's why we're an appreciating market as opposed to a cash flow market when it comes to real estate investment. And that kind of ties along with another great benefit, which is leverage. The example I like to use is if you're going to invest in stocks, let's say you have $250,000, $250,000. If you go buy stocks, generally speaking, you're buying $250,000 worth of stocks. Yes, there are abilities to margin, but it's limited. So you have $250,000 in stocks, and let's say those stocks appreciate 10%. Nash is coming back. So if those stocks appreciate 10%, you just made $25,000 on your $250,000 investment. But when it comes to real estate, that same $250,000 can be leveraged with a loan and buy you potentially $1 million or more in real estate. And if that $1 million asset now appreciates by 10%, you just increased your net worth by $100,000 on your $250,000 investment, which is great. That's a lot. So that's leverage and why it's an awesome reward of real estate. Whoops. And last but not least, what's that, Nash? Welcome back.
Thanks. That's my favorite benefit of owning real estate, which makes it just
the leverage piece.
Yeah, the leverage piece. Sorry, I bailed out for a second.
Well, welcome back. So that was the second key: understanding risk, recognizing opportunity, and of course, if you're looking beyond house hacking, we can talk much more about risks and opportunities, potentially in this market or other markets. So let's have the conversation if anyone's interested. Tell us about the third key.
Third key, building a team and surrounding yourself with professionals with your interests in mind and the ability to make deals happen. Joe and I would love to be that team. We have a passion for helping people build wealth through real estate, and we take our passion very seriously. We're happy to get together with anybody on this call one-on-one to take the time and understand what your goals are and what's important to you. And it's our mission to make sure that we're successful. And furthermore, we can utilize our network of vendors and professionals to make sure that you receive the best service and you're successful with the least amount of hassle. Yeah. And this is kind of... Oh, go ahead.
Oh, yeah. I was going to say, we like to include this slide to show that there's a lot of moving parts and pieces to a real estate transaction. And you can see that there's kind of, I created this and it's not as pretty as it could be. Yet you can kind of see that there's three hubs. There's you, there's your realtor, and there's your lender. And they're your team. And those are the people that help connect with everything else that happens in a real estate transaction, like the escrow and title insurer and the home warranty and natural hazard and inspectors and all that stuff. So there's a lot of moving pieces, and it's important to have a strong triangle. I remember back in real estate school that it was all about the triangle of trust, I think is what they called it. Realtor, lender, you.
What is natural hazard?
What's that natural hazard? Great question. So when you're buying a property, you're going to get a natural hazard disclosure statement and probably a natural hazard report as well. Essentially, it talks about all of the known natural hazards and some man-made hazards that exist near the property. So the big ones include fault lines, landslide zones, wildfire regions, liquefaction zones, which that's this thing that happens with earth shaking on sandy, wet soil where it acts like a liquid, essentially. So yeah, good fun. Google it if you want to see some interesting photos. Flood zones, dam inundation zones.
Tsunami zones.
Tsunami, yep. And then the man-made hazards, such as hazardous liquid transmission pipelines, as well as leaking underground storage tanks. For example, an abandoned gas station that still has a storage tank underground that is known to be leaking. If you're living next door to it and you want a garden, that's a problem. Yep. So great question. Thanks for pointing that out. We did it. We talked about the 3 keys for success. Anything to add, Nash?
No. I think we should go on and talk about Ben and Abby.
Sweet, let's do it. So we covered my story. We covered 5 of the most common myths, the 3 keys to success. And now we'll talk real quick about how it happens in real life with recent clients, Ben and Abby. It's kind of a quick case study.
So Ben and Abby were looking for a property in Oakland about 3 years ago, and they were getting a little discouraged. They had some modest savings, but not enough to come up with 20% down on some of to stay competitive on the single family market. And we were able to find them a duplex in Fruitvale where they could use an FHA loan. It was listed at $795. I think we got them in at $810. So around $30,000 for a down payment. And it was a duplex. So it was 2-bedroom, 2 units, both 2-bedroom, 1 bathrooms, which wasn't enough for their growing family. So they put some sweat equity into it. They converted the owner unit, that was a 2-bedroom, 1 bathroom, into a 3-bedroom, 3-bathroom. They did an addition while renting out the downstairs unit. And the downstairs was renting out for about $1,750 that they were able to put towards their mortgage and expenses. And after they closed on the deal at around $805, around $800,000, and the sweat appreciation, the house recently appraised for over $1.1 million, which is over, close to $300,000 in appreciation in just a couple of years, which is more than I make in real estate. Yeah. So, one of our favorite success stories, and that was all.
Yeah, and
go ahead.
A big part of the success at the end there, like, yes, it appraised for $1.1 million, and that's all great and dandy, and I'm sure they feel really good about it. But during that process, because they bought with an FHA loan, it comes with mortgage insurance, which is an extra, it's like, in their case, it was an extra $700 or so a month. So when they got it reappraised, they were then able to refinance into a much more competitive conventional loan product and drop their payments by over $1,000 a month. And that's I don't know, to me, that's a huge win. I love that.
It's a lot of money.
And I know, a common question that we get is like, well, I mean, they had to invest all that money into adding that sweat equity. And they kind of went the route that I did. It's not a true addition. It's actually an attic space that they are permitting including into their house. And Ben is doing a lot of the work himself, and he loves it. So he gets to win on that front and build all this wealth with not a lot of money out of pocket. So huge win. And this is, an example of a win with an FHA loan too. I know there's a lot of stigma against FHA loans. Well, maybe you haven't heard. Generally speaking, the word on the street, I guess, is that FHA is hard to get your offer accepted. It's because it's a low down payment program and they're picky. The truth is, it's not. It's yes, there are some restrictions and limitations, but in most cases, it's absolutely achievable. So that's Ben and Abby. Cool. I just saw a question go by. Was that a spreadsheet question? Oh, you can't. Nash, can you read chats? Okay. All right. Let me open my chat. I'm probably going to freeze for a second.
So just moving along, were you reminded of at least one thing, or did anybody learn at least one thing to take away? If you did, love to hear some feedback in the chat box. And it, essentially, I hope everyone had some solid takeaways, and if not, feel free to reach out to Joe and I if you have any other questions that we didn't get to. But essentially, you have two choices. You can do nothing and continue to rent and pay your landlord's mortgage, or you can choose to invest in yourself, in your future, and start your journey through building some real wealth through real estate. So to get started, number one, identify your goals. Hopefully on this webinar, you figured out if house hacking or got a better feel for if house hacking is the right fit for you, and if it's the right fit for your real estate goals, or if some other strategies might be better for those goals. Again, we're happy to engage with you and see what those goals are and point you in the right direction. Can we get a copy of the Clash Royale spreadsheet? Yes, you can.
Yeah, everyone's going to get a copy of the spreadsheets. And I think I promised some recession slides as well. And if there's anything else we can help with, of course, let us know.
Yeah. Second step to getting started, engage a lender. Taking the time to vet a lender will give you a lot of clarity around what a comfortable monthly payment is. Once you get some clarity around what a comfortable, what you're qualified for as far as a price range, you can look at inventory in that range, see if anything appeals to you, and at that point you're ready, and you can actually write an offer on something that comes up. Again, we're going to start to see a lot more opportunities coming up in all areas in the Bay Area, but the good deals go quick. So it's important to talk to a lender and see what you're qualified for, and stay ready, because the good deals are going to move. They're going to move fast. Also, our buddy Robert, he's one of our preferred lenders. He's a house hacking wizard. So he really takes the time to understand what your goals are and can help tailor a product that's going to work best for you. We have done a number of deals with him, and we will make sure that everyone on the call has his info, just so you can use him as a resource for a pre-approval if you're looking to get started.
Thanks, Nash.
Yeah. Third step, drink coffee. At the Joe Dickerson Group, we are big fans of coffee. It's ingrained in our culture, and we'd love to buy you a cup of Joe, no pun intended, and map out a plan of attack. Get a needs analysis, figure out what your goals are, what's important to you, and make sure that you're successful in reaching your goals.
Awesome. Thank you, Nash. Yeah, that pretty much sums it up. We'd love to be a part of your house hacking and real estate investing journey. We've helped, I think we're at 35 families house hack, which is pretty exciting. And that's just in the past, 3 years since we've been counting. So it's a real part of what we love to do to help people build wealth through real estate. We'd love to be a part of your journey as well. As promised, you will all get the investment analyzer doohickey spreadsheets. The one requirement is that you have a Google account. This is a Google spreadsheet. So we'll attempt to share it with whatever email you registered with, and we'll reach out if that one bounces because it's not a Google account.
Cool. So I am curious to hear if anybody has any more questions or what some of your takeaways were from the webinar. Feel free to throw them in the chat box or unmute yourself. We're going to hang out for a little bit and answer the questions that people have about the webinar, about the market, or anything else you want to chat about.
Yeah, and thank you all so much for coming and joining us. We wish you the best and however you choose to pursue, but we do hope that you do something to help build your and your family's wealth.
Yeah, it's
FHA
really
loan compared to
traditional mortgage.
yes, compared to a traditional mortgage. Yeah, so the big advantage with FHA is that it's a much lower down payment program. You can get into a house, even a multi-unit house, with as little as 3.5% down. And the interest rates are competitive. The big downside is it comes with a huge mortgage insurance payment, both upfront as well as monthly. So Robert can quote the prices. If I remember correctly, it's around 1.1% of the loan amount per year.
Yeah, so 1.75 is financed upfront, and you're right, Joe. Depending on the loan amount, it can be as high as 1.1% that you pay, yeah, monthly, but it's assessed annually. Mm-hmm.
Yeah. Christina asks, what qualifies someone to refinance after an FHA loan, and how soon can you refinance?
That's a great question. Usually it's 6 payments. So as soon as you've made 6 payments, we can refinance you. And I usually am doing that with most people that are in an FHA loan, getting them out of that. So that's definitely an option.
Yeah, and especially with our, because we've been in such an appreciating market, it's, even though you're only putting 3.5% down, often after a year or so, you've built enough equity to be able to refinance into a conventional loan. We've seen that a lot.
Yeah, definitely.
Yep. Did I miss any other questions?
Yeah, and you know, I can't say enough about an FHA loan. It's a great way to acquire an asset and start building wealth and equity. I don't think it's a long-term. I don't think it's a great long-term product, but it's great to acquire the asset, build equity, and then refinance onto something long-term. How's math work out between FHA and a traditional adjustable rate mortgage? Is it possible traditional and adjustable rates are better? Adjustable rates they're a little bit risky because if you're on a 7-year or 10-year adjustable rate mortgage, there's no telling what the rates are going to be when it corrects onto what the market is in 7 or 10 years. And there's no telling what the market's going to be like. If you're in a down market and you want to sell your house because your rate's going to increase, it might not be possible or it might not be ideal. You know, I'm a big fan of the 30-year fix. Just rates are low across the board right now. But one of the reasons that FHA is so great is it requires only 3.5% down, which you could do that for 6 months, then refinance on something a little more long term.
Yep. But the adjustable rate mortgage is also, it depends how long you plan on keeping the house. If the plan is to move on, sell, or, oh, my microphone's dead again.
Very good.
Okay. All right, I'm switching to speaker, I guess. Oops, wrong way. Yeah, I said Google, and my new Google EarPod things heard me and wanted to switch to talking to my Google Assistant. What was I saying? Adjustable rate mortgages. If your plan is to sell the home in 3 or 5 years, then an adjustable rate mortgage might make sense. Pay less interest in the meantime, knowing that you're going to sell the home before it starts adjusting. So there are times where it makes sense. But for a long-term buy and hold, I personally avoid them because we don't know what the interest rate environment is going to be when it starts adjusting. All right, did I see one other question pop in? Are there any stats on how many people use FHA loans? Ooh, I don't know, Robert, are there stats on how many people are using these loans in our area?
I don't know if you can drill it down to area specific. I'm sure there's a way to if you bought the data, but a lot of people use FHA loans. It's a really common loan product.
Are zero money down deals?
Yes.
Not really.
No.
Yeah, unless it's a VA loan, lenders really tightened up their criteria in the last couple months because they were concerned about volatility in the market. But zero money down deals, that's one of the main reasons that we saw the mortgage market crash in 2008 was they were offering all these products without anybody having actual stakes in the home, and kind of backfired. So if there is a zero money down deal out there, there's probably a caveat, and Robert and our team.
Let me add to that real quick. So it wasn't so much the zero money down loans that killed the market. It was that they had really aggressive features to it on top of being zero money down. So you're right. You didn't have any equity, Nash. So that was a good point. So you couldn't get out of it. You couldn't sell it. It was hard to refinance. And I apologize for the background noise. I had to jump on the road here. But when it came to the aggressive features, it was negatively amortizing, had prepayment penalties, other, balloon payments, et cetera. So we don't have those anymore. There are down payment assistance programs out there. They've severely been cut back with the recent economic changes. They'll come back into the market soon enough, but they're not really, there's no down payment assistance programs eligible to buy a 2 to 4 unit property. Because there's an investment feature to that, there's no down payment programs that fund those. A lot of these down payment programs are funded by state bonds or local bonds, and they just don't offer. I wish they did. I think it'd be awesome if you could use down payment assistance towards a 2 to 4 unit property, but it's just not out there. So I would say, the best thing to do is to save up 3.5% down, or, borrow money from friends or family, or, see if you can draw from retirement. But anyway, you can get your hands on 3.5% down to get into, a 2 unit property using an FHA loan. That's a great start and a great way to build wealth really quickly.
Yeah.
Thank you. And there, you may find also, I don't want to get too much into this, but for zero money down is seller financing options as well. Now, very rarely is a seller going to want to do a seller financing without any money down, yet I guess it's not impossible to find.
Downside of an FHA loan, Robert.
Yeah, I think we covered that a little a few minutes ago, but just primarily what Joe was mentioning. There's a mortgage insurance premium that's financed into the loan. It's almost 2 points. You're immediately underwater on an FHA loan. It's not so much the case in Alameda County because your property's going to, probably appreciate really rapidly. But the reason I say that is because you're putting 3.5% down, and then you're financing 1.75% of the loan amount. So you have less than 2% equity when you're starting out, and you need 5 or 6% to sell a property because you have to pay real estate fees. So, there's definitely downsides to it. You want to be aware of all the things involved. The mortgage insurance you pay monthly that gets assessed annually at 1%. That increases your payment a lot. So it's kind of a costly loan in some ways, but at the same time, it's incredibly flexible as far as guidelines are concerned. It's the lowest down payment program out there by far. So I don't see any downsides to utilizing it for the purchase of a multi-unit property. I think for that purpose, it's just a great way to get started to build wealth. I mean, we had a client that bought using an FHA loan in December of 2018 with 3.5% down, and did a light remodel. And within like 6 months, no, maybe a little more than 6 months, maybe 8 months, we did an appraisal to do her refinance, and she'd gotten like $400,000 in equity. Now that's an insane example, but it's not unheard of. It's not. So it's like, sure, there's a cost to it. There's definitely cons to it compared to other mortgages. If you have a higher down payment, we should definitely do a conventional mortgage. It's going to save you money. But the difference, the gap between the down payment for an FHA mortgage and the down payment for a conventional mortgage on a multi-unit property is huge. Like, you need a minimum of 15% down to buy a duplex with a conventional mortgage, whereas you need 3.5% with an FHA loan. So I don't think the cons outweigh the benefits.
Thank you. And to finish up there, John Snow asks, is the PMI does not drop off? That is correct. The PMI will stay as long as we're in that FHA loan these days. That wasn't the case when I bought my second house, but it is today. Sorry. All right, next question from Chris. Which are better investments, townhomes or duplexes? Well, to me, it's obvious that I'm a big fan of the multi-unit. So I would say duplex. You own two units, and it typically doesn't cost twice as much as owning one unit. And at the same time, you get the rental income in the meantime. And then the long-term cash flow potential, at least in our area, I find is greater with more units.
However, a townhouse, if for an initial investment, is a great way to start building wealth. Still better than renting. And it depends on what your goals are. I mean, if you don't want to manage tenants and you can get a sweet deal on a townhouse, there are ways those are great investments as well. We're also seeing the condo market and the townhouse market. It's a lot softer than it has been in a while. So, if you bought a townhouse or a condo at a discount, when things get back to some level of normality, you have some forced appreciation there. So it's all subjective, but it really depends on, I think, what your goals are.
Yep.
Can you write off PMI?
You can on the investment portion of a property. So PMI is private mortgage insurance. And then on FHA, it's MI for mortgage insurance. I guess technically it's public mortgage insurance. And yes, on an investment property, you can write those off. On a primary residence, you, last I checked, cannot.
I think if you make less than 109,000, you can.
Cool. Okay.
That might have changed.
Yeah. Okay. So check with your CPA. But on an investment property, I know that you can. And that, again, includes house hacks for the portion that you're renting out. All right. All right. Any last questions?
Joe, is that your artwork behind you?
Yeah. Yes. These are all my pieces. No, this is my 6 and 7-year-old doing some art. Thanks for asking.
Where are we going to post the replay? John, we'll email it to everybody. Make sure that you have it. But again, if anybody has any follow-up questions, the door is always open. Please don't hesitate to reach out. We'd love to connect with anybody one-on-one to do a more personal needs analysis and see what we can do to help you be successful.
Yes, and I understand that it did go by fast. House hacking it's a big deal. Buying a house is a big deal, so there is a lot to know. And the purpose of this was to hopefully round off some of the corners, I guess, dispel some myths and give you some keys to success. And yet there's likely more work that all of you need to do to actually achieve some seriously awesome results. And we're here to help. Okay, so yeah, I think we answered those. I'm just skimming through the questions, make sure we answered them all. I think we're good. All right, thank you all. Oh, look at that. There's that's our YouTube channel, so you can get some insights there. Most recently, we posted on the impacts of shelter in place on our real estate market as it relates to inventory, which I find really interesting, and you can probably tell that I find it interesting when you watch the video. And there's some other goodies there related to house hacking as well. There's some case studies, there's some advantages, disadvantages. Check it out if you're interested. But again, we're here for you and would love to get on the phone one-on-one or Zoom or whatever it is and help you towards your goals. So with that, thank you all for coming. Please stay in touch and we'll reach out as well and make sure that your needs are covered. I'm Joe Dickerson.
I'm Nash Middleman. We got Robert on the call. He's one of our favorite listeners. And we're here to help you guys build up through real estate. So don't be strangers, and we'll hope to talk to you all soon.
Great.
Thanks, guys.
All right. Thank you.